All right, we are about to pull back the curtain on a really powerful and honestly often overlooked financial strategy. It's this fascinating spot where housing, healthcare, and the tax code all collide. We're going to do a deep dive into a unique opportunity for seniors that could literally change the game for your wealth preservation plan. So what if I told you that this number, $190,000, could be a one-time tax deduction? Seriously, that's not a typo. This comes from a real-world example, and it shows you the kind of massive deductions someone might get from the entry fee for a continuing care retirement community, or a CCRC. It's a totally fair question, right? How on earth is that possible? Well, the answer is hiding in plain sight, in this really interesting and kind of rare anomaly within the U.S. tax code. So we're going to investigate exactly how this works, who it's for, and most importantly, what makes it totally legitimate in the eyes of the IRS. Okay, so to get to the bottom of this, here's our game plan. We've got 5 sections. We'll start with the big idea, then we'll look at the legal history that makes it all possible. After that, we'll decode the contracts. That's the key. Then we'll walk through the math step by step and finish up with the crucial paperwork you'll need to make your case. So let's kick off our investigation. The entire strategy really hangs on this one, very specific, and pretty unusual idea. The concept that you can get a tax deduction for paying for medical care you haven't even used yet. And here's the core idea. Normally, the tax code is all about pay for what you get. But in this case, the CCRC entry fee is treated more like an insurance premium. You're not paying for the doctor you saw today. You're paying for the guarantee that you'll have care available down the road. You're basically transferring the financial risk of your future healthcare to the CCRC, and the IRS says, yep, that transfer counts as a deductible medical expense. Now, a deduction this big, you better believe it needs a rock-solid legal foundation. And it has one. This isn't some shady loophole. It's a well-established principle that's been built up over decades of IRS rulings and court cases. Let's check out the history. This timeline really tells the story. Back in '76, the IRS gave the initial green light, saying, yes, this makes sense, even for perfectly healthy residents, because they're buying a promise. Then in '93, they added a huge clarification. You can only deduct the part of the fee that you're never getting back, the non-refundable part. And finally, in 2004, the Baker case basically gave us the roadmap for how to do the math, validating the calculation method we still use today. And this brings us to what I call the contractual cliff. That 1993 ruling drew a hard line in the sand. If you can get a chunk of your entry fee back someday, the IRS doesn't see it as an expense. They see it as a loan or a deposit. And because of that, it is completely 100% not deductible. This one rule changes everything. That contractual cliff leads us right to the single most critical piece of evidence in this whole investigation, your residency contract. The specific type of contract you sign is everything. It dictates the entire outcome. This table breaks it all down perfectly. See that Type A, the life care contract? That's the gold standard here. You pay a big entry fee up front to basically lock in your future healthcare costs. It's the purest form of prepayment, so you get the biggest deductions. Type B is a middle ground. But look at Type C, fee for service. It's a total paradox, right? The entry fee is lower, which sounds good, but it means you haven't prepaid for care, so there's almost nothing to deduct. So what's the real difference? It all boils down to risk. A Type A contract, think of it like an insurance policy. You pay a big premium, that's your entry fee, to hand off the financial risk of your future health to the CCRC. A Type C contract is the complete opposite. You're basically self-insuring. You pay as you go, and you hold on to all of that future financial risk yourself. No prepayment means no big upfront deduction. Simple as that. Okay, so we've got the theory down. We understand the legal side of things. Now let's get practical. Let's roll up our sleeves and actually see how you calculate this deduction. It really just boils down to these 3 simple steps. First, you take your total entry fee and you subtract anything that's refundable. That's step 1, avoiding that contractual cliff. Second, you take that non-refundable number and multiply it by a percentage that the CCRC gives you in a letter every year. For Type A contracts, that's usually somewhere between 20 and 45%. And third, and this is the final hurdle for all medical deductions, your total medical expenses for the year have to be more than 7.5% of your adjusted gross income, or AGI. And this is why this is such a game changer. For a lot of retirees, taking the standard deduction is just easier. But a big CCRC payment can totally flip the script. You can see in this example, when you add a hefty CCRC deduction to your other itemized expenses, it can blow the standard deduction right out of the water. We're talking about major tax savings in that first year you move in.
All right, we're in the home stretch of our audit. You've spotted the opportunity, you get the law, you've run the numbers. Now for the most important part, you have to be ready to prove it. The burden of proof is 100% on you, the taxpayer. So good documentation isn't just a good idea, it's your best defense. You have to understand this. There is no magic IRS form for this deduction. You know that letter your CRCC sends you at the percentage? That's a courtesy. They're not legally required to send it. The responsibility to build the case, to keep the records, to prove everything, it falls right on your shoulders. So what does a truly audit-proof file look like? Here's your checklist. You need the signed contract. That's your number one piece of evidence. You need the settlement statement showing you paid the fee. You absolutely have to have that official year-end letter from the CCRC. If you can get your hands on it, the independent auditor's report that shows how they calculated the percentage is pure gold. And finally, the basics. Proof of payment, like a canceled check. This is your forensic evidence file. I think this quote just nails it. It perfectly captures what we've been talking about. A CCRC entry fee isn't just one thing. It's partly for your housing, sure, but it's also a premium for an insurance-like product, and as we've just seen, it can be an incredibly powerful tax shield. You have to understand all three parts to really use it well. So that leaves us with this final question to think about. We tend to think of assets as stocks or bonds or the house we live in. But what this investigation shows is that for the right person with the right contract, that document you signed to move into a CCRC, well, it could end up being one of the most valuable and strategic tax assets you own. And that leads to my final and I think most critical recommendation. This is not simple stuff. So before you sign on the dotted line of any CCRC contract, the absolute smartest thing you can do is have your CPA run a pro-forma, basically a practice tax return, for the year you plan to move in. This will show you the real dollar benefit, help you pick the right contract, and make sure you walk in with your eyes wide open, ready to use this powerful strategy.